Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now till the closing bell, and stocks are falling. But making even bigger moves today are the metals. And our very own Ines Ferre is here with the latest. Ines.
Yeah, Josh, some record drops is what we're seeing in the metal space as that precious metal rally that we've seen all year long just unwinding in a severe form right now. If we take a look at our Wi-Fi Interactive, you'll take a look at gold futures down 7%, but at one point they were down more than 11%. Spot gold has seen its biggest drop since the early 80s. Also, silver seeing its biggest drop on record. Silver futures down more than 26% right now. Now, you could say that Trump's pick of the next Fed chair, Kevin Warsh, he's seen as more of a hawk, so that doesn't bode so well if you're looking at a weaker dollar, more looking at a stronger dollar. But traders will tell you that, look, this rally was ripe for a pullback, for a correction, given the speed of this rally. If we just take a look at where we're at with the U.S. dollar index, we have seen that moving up. Also, Mike McClone over at Bloomberg just noting that there's always sound fundamentals when it comes to reasons for a rally, but the price action, the speed of the rally is really what was so concerning with these metals, and the deficits can shift very quickly. Do want to point out what's been happening with Bitcoin, because amid all the volatility that we've seen with commodities, with stocks as well, Bitcoin holding up just around 84,000 per token. 10x Research writing a note today saying that Worsh is seen as more of a hawk, so wouldn't bode so well for a crypto rally, but nevertheless, crypto today holding up amid all that selling that we're seeing across the board. Josh?
All right, Ez, thank you. President Trump making his first comments about Kevin Warsh after announcing his nomination to replace Fed Chair Jerome Powell. Fed correspondent Jennifer Schonberger here with more. Jen.
Hey there, Josh. That's right. President Trump weighing in this afternoon for the first time on his nominee to be the next Fed chair, Kevin Warsh. The president was asked in the Oval Office by reporters whether Warsh would commit to him to pushing through interest rate cuts if confirmed. The president said no, he did not ask him about that.
I've been following him, and I don't want to ask him that question. I think it's inappropriate, probably would be allowed, but I want to keep it nice and pure. But he certainly wants to cut rates. I've been watching him for a long time.
When asked whether he has concerns about Warsh's historically hawkish stance, the president said at times he too has been in favor of raising rates when it's appropriate. Now, the president said he wanted to keep National Economic Council Director Kevin Hassett as one of his top economic advisors, saying that he does, quote, a fantastic job. The president also brushed off questions about whether he had concerns about getting Worsh confirmed by the Senate, given that Republican Senator Thom Tillis has vowed to block any nomination of the president's until the criminal investigation into current Fed Chair Jay Powell is resolved. Now, if Worsh is confirmed, he will face a divided Fed at a time when this 19-member committee is setting up for a pause in rate cuts. Underscoring that just today, St. Louis Fed President Alberto Musalem said he thinks that rates currently in this range of 3.5% to 3.75% are already at neutral, a level designed to neither spur nor slow economic growth. Musalem saying that given that the inflation rate is above the Fed's 2% goal still, he does not favor cutting rates further at this point. He thinks it would put the Fed into accommodative territory. On the flip side, we also heard from Fed Governor Chris Waller, who was out with a statement as to why he dissented at this week's policy meeting, preferring to cut rates by a 0.25 percentage point rather than holding rates steady. And again, Waller citing concerns about weakness in the job market and the Fed needing to shore that up further. Needless to say that analysts say that if Worsh is confirmed, he will have a lot of convincing to do for this 19-member committee. Josh?
Jen, thank you. Join me now for more on the Fed. We got Dennis Lockhart, former Federal Reserve Bank of Atlanta president. Dennis, it is always great to see you. So I do want to start there. Trump nominating Kevin Warsh as Fed chief, Dennis. One storyline here, Dennis, and you probably know where I'm going with this, is, listen, we think of Mr. Worsh historically, traditionally, as hawkish, concerned about inflation. And now the story goes, he seems to have changed that stance, right? Shifted that. I saw one well-known market watcher, he was writing to his clients this morning, Dennis. He said, will the real Kevin Warsh please stand up? What do you make of this?
Well, far be it for me to attribute to any of the candidates motivations other than they just were talking about the policy they thought made most sense. Kevin is a pragmatist, and I think he looks at the situation in very pragmatic ways, and I suspect that he's genuine in his belief that there is room to cut further, perhaps in the near term. But at the same time, his longer-term leanings, as I observe them, have been really more focused on inflation risk. And we'll see how he reconciles sort of his philosophy with the pragmatic decisions of the moment.
We're very focused on this news today, Dennis, and for very good reason. I've heard some folks raise this question. I'm interested to get your take. They say, listen, stay focused on this, of course, but they ask, how much change could Warsh really make if he was given the official nod? He is, they say, here's the argument, ultimately he's one man, one vote. He's the chair. That's critical, of course, but the FOMC sets interest rates, and I'm curious to get your take.
Well, I kind of agree with that point of view. The chair can influence the Fed, but the Fed influences the chair a lot as well. And what I mean by that simply is there's an institutionalized way of doing things. On the margin, I think he can make some fairly early changes, particularly those that where he's choosing how to communicate, for example. But I don't think there's going to be a revolution in the way the Fed operates, and I think it'll be more gradual. He will have to earn the respect of his colleagues, and which I think he will, and then he'll have influence on how the Fed operates.
Let's talk about some of those changes, Dennis, that he's talked about, right? Worsh, for example, I'm curious to get your take here. He's called, for example, he thinks the Fed should reduce the size of the balance sheet. What do you think of that, Dennis? Is that smart policy? And for investors who are listening right now, if we remove that kind of liquidity from the system, what could that mean for the stock market, Dennis?
Well, I'll give you a off the top of my head response. This is a really, really technical area of, the reserve levels that the system wants and needs. Therefore, whether to have an ample or scarce reserves approach to things. Kevin seems to want to kind of return to a simpler and really historic positioning of the Fed with scarce reserves, small footprint in financial markets, smaller balance sheet, therefore. Whether that can be done without some financial stability turbulence associated with it, I just don't know. I think it's going to be a more technical path than simply wishing that you could return to the past.
Here's a couple other changes he's made, Dennis. Interested to get your insight. I'll double barrel this one. One, reduce staff at the Fed. That's interesting. Also, less Fed speak, Dennis. Too much talking going on. What do you make of those two?
Well, I'll take the second one first. The too much Fed speak has been a complaint for years and years and years. The word cacophony has been used a lot. There's something to be said for that. At the same time, the Reserve Bank presidents, particularly who speak very freely and go out frequently, are in many respects communicating to parts of the country that they oversee, and it's viewed by the public, I think, in various districts in the country as a very valuable connection with the Fed and understanding more of what the Fed is up to. So I think, maybe he can bring greater order to that. We'll see. I'm not so sure.
One part of his resume that's interesting too, Dennis. Listen, he's a Wall Street veteran, working with Stan Druckenmiller, right? One of the greats. Obviously understands markets. If he did get the official nod, how valuable would that be, Dennis?
Very valuable. Very valuable. In the past, we've had chairs that I worked with who were absolutely outstanding economists, but had relatively little market experience. I think Kevin is well immersed in the economics and the monetary policy theory and practice, and at the same time has market savvy. And so I think that's a great combination. To a degree, I think Jay Powell brought the same kind of sensibilities of having been in business and worked in private equity, understood the business side of the equation. So I think Kevin checks all the boxes, frankly.
Finally, Dennis, since I have you here, I want to know, we heard from the Fed this week. They decided to stand pat, right? Did you agree with that call, Dennis?
Oh, yes, I did. I think the 3 cuts at the end of last year put them in a very good position. The economy seems actually, in terms of growth, to be strengthening a bit. The employment situation is sort of static. It's not really deteriorating rapidly. And inflation is kind of stuck at 2.7 to 3%, depending on how you measure it. I think it's a good time to wait and see how things evolve and then take action. And I don't expect, while Jay Powell's still there, I don't expect to see a rate cut in the first half.
Dennis, always great to see you. Enjoy the weekend.
Thank you so much, Josh.
Meantime, the market tumbling to close out a volatile month. Investors digesting the Worsh news, of course, plus the wild metal trade and earnings. Join me now. We got Jeff Bookbinder, LPL Financial Chief Equity Strategist. Jeff, it is great to see you. So obviously, listen, we're going to start here. Trump nominating Kevin Warsh for Fed chief. Now, some are arguing, Jeff, and get your take on this. They say, listen, this is good news for stocks. And they're pointing, Jeff, to this editorial that Worsh wrote in the Journal, where he says, the Fed should abandon the dogma that inflation is caused when the economy grows too much and workers get paid too much. Some folks, they looked at that, Jeff, they read that editorial, they saw the news today, and they said, good news, cuts are on the way. What do you think of that?
Well, first, Josh, thanks for having me on. I'll just say that the cuts were coming anyway, right? And we've penciled in 2 cuts along with the market. Whether we got a Hassett or a Reader or anyone else, frankly, we think the odds were good that we were going to get a couple of cuts. That is helpful in anchoring the 10-year yield. Of course, those are 2 very different yields, but should anchor the 10-year yield, we think. And then as inflation comes down over the course of the year, 10-year yield likely to come down as well. And that is certainly positive for the stock market. Perhaps the one piece of that the market will just have to figure out how to deal with is the balance sheet size, right? And if you have upward pressure on the long end of the curve from concerns about a shrinking balance sheet, that could put a little pressure on stocks. But we still think the backdrop is very, very favorable for this market right here.
Can I ask you, Jeff, there's a flip side to Worsh. There's another storyline, which is that traditionally you thought of Worsh as hawkish, concerned about inflation. I wonder, do you think this headline that Trump's saying, okay, this is my guy, right? Somebody who's typically seen as hawkish. Do you think that helps explain, Jeff, the moves we're seeing today in the metals like gold and silver, which is getting walloped?
Well, the market was looking for an excuse to sell these metals after these meteoric rises. So we would focus more on the dollar specifically. In fact, the dollar, we think, is eventually going to break this trend around 96 on the DXY index, and that could be very positive for emerging markets. Now, we'll bounce a little bit on this Worsh news, again, potentially related to the market's views on how hawkish he will be and what he might try to do with the balance sheet. But if we do break that 96 level on the DXY, we think emerging markets make a lot of sense, and non-U.S. equities more broadly.
Jeff, let's just turn to your thoughts on the broader market here, because you are pointing out here in your notes, economy's resilient, earnings growth solid. This sounds pretty good. This sounds constructive. What would be your year-end targets for the SPX, Jeff? What are you looking for?
Yeah, at LPL, our year-end target is 7,300 to 7,400 on the S&P 500. But as earnings have come in, frankly, the earnings outlook has been strengthening for the past couple of months since we put out that target. We're probably a little more likely to be in our bull case scenario, which is 7,800. So we see some upside to that. Earnings season's been pretty good so far. Certainly, we've seen some stocks react more positively or more negatively to results. But if you step back, we're going to be in mid-teens on earnings growth for the S&P 500. That is a really nice foundation for this market. You've got stimulus coming very soon with the One Big Beautiful Bill Act, that fiscal stimulus, plus the AI investment, which, by the way, is another reason why I think Kevin Warsh thinks we can grow with less inflation. That AI investment is going to make this economy, we think, grow 2.5% this year. And 6 months ago, we didn't think we were going to be that strong. So strong economy and certainly the potential for inflation to come down over the course of the year. That should be a good environment for stocks as long as the 10-year yield cooperates.
Jeff, in terms of sectors here, you say weakness in tech is overdone. Why, Jeff? Explain that one.
Sure. Well, the tech earnings are coming through. The capital investment for AI is probably going to be up 30% this year. Now, there'll be fits and starts around concerns about whether that investment will actually bear the fruit that the market wants. But that right there makes 30% earnings growth for tech very likely. And the sector is trading at about 26 times forward earnings. That's a PEG ratio below 1. Materials is the only other sector that can say that. So we think the valuations, while many point to them being elevated, ensure the tech sector trades above the S&P. But based on the earnings growth outlook, we think the selling here might be overdone. Now, you got to watch software carefully. Software is in the process of bottoming. Certainly, the market is understandably worried about the impact of AI on software companies. We get that. But once software finds its footing, we think that the tech sector will look pretty good here. So that's an area we're actively looking to add to.
Jeff, great to have you on the show today. Thank you.
Thanks, Josh.
Coming up, SoFi CEO brings us the details on the company's record fourth quarter earnings. That's next on Market Domination. Now it's time for some of today's trending tickers. Brooke DePalma joining me here for a look at Deckers, Verizon, and Bombardier. Let's start with Deckers Outdoor, the makers of UGG shoes, reporting a stronger 2026 outlook than Wall Street estimated. The company is pointing to its Hoka running shoes, setting the pace for sales. Stock higher today. We should note, probably, Brooke, this stock, I mean, it is down about 50% over the past 12 months.
Over the past 12 months, down about 47%. But seeing this remarkable run up today, the excitement that Wall Street has about this potential, most of which many analysts, and I have to look at exact numbers, but at least two of the notes that I saw are on the sidelines here. They're neutral. They're really waiting for maybe a little bit more from the company. But what was encouraging today and really easing investors' fear on this company is that they did see that stronger than expected sales. They also had bullish guidance. Simeon Siegel at Guggenheim saying that Hoka was nicely ahead of the street, the sneaker brand. Also UGG beating as well. And he said within the note to clients that management highlighted that Hoka saw a positive inflection specifically here in the U.S., also pointing to Hoka's gross margin improve year over year despite concerns around a promotional holiday. And on top of that, tariffs weren't as bad of a hit as Wall Street had anticipated there. And also Dana Telsey pointing out within the note, while third quarter results were encouraging, they expect investors to look for more sustained momentum here.
All right, Brooke, the next one on our radar, Verizon, the telecoms company reporting earnings beat. Its profit guidance came in above expectations. Wireless subscriber numbers at 6-year highs. This all comes despite Verizon announcing mass layoffs in November. Plans to buy back as much as $25 billion in shares. I saw that too. New CEO Dan Schulman, who used to run PayPal, of course, saying, "We are now going to play to win, and we will never again be content to be the hunting ground where our competitors take our share and our customers.
I'm a little scared.
Strong words.
Strong words initial. But definitely what goes to show is this is his first quarter really leading the helm of this company, and definitely there's some excitement about what this could eventually turn into. Evercore ISI saying that Verizon's fourth quarter results were generally unsurprising, though, given the recent leadership change and CEO Dan Schulman's focus really on this. In addition to that, we have to note that what we did see was that Verizon promos such as 4 lines for $100 really resonated with consumers, and that really led to monthly bill-paying wireless phone subscribers over the last 2 months of 2025 surpassing Wall Street's expectations. And so maybe one to watch here.
All right, finally, playmaker Bombardier is getting caught at the crosshairs of more tariff wars. President Trump today threatening to slap 50% levies on all Canadian-made aircraft. Bloomberg citing TD Cowen analysts as saying, even if actions, they said, threatened by Trump were averted, we believe there will be heightened and potentially drawn-out investor sentiment and valuation multiple pressure on the company and other Canadian aerospace companies that export to the U.S.
Yes, this is traded on the Toronto Exchange here. Now, as we make our way towards the close, down about 6.3%, so somewhat of a slide here. And what we do know is that this is sort of emphasizes this larger landscape of these tariff talks continuing to ripple through the markets, even though we felt like we got past it in 2025. Now, as we enter into 2026, this ongoing uncertainty about what exact tariffs would go into effect is lingering here and definitely impacting this stock as well. And when you think about the market, the opportunity that the U.S. has, U.S. being the larger, from what I understand, buyer, user of these private jets, definitely a significant impact for this company. And that's why we're seeing it lower today. And over the past year, worth noting that this company has a significant run up about 165%.
Wow. All right, thank you, Brooke. Appreciate it. SoFi shares pairing earlier gains, the stock initially jumping after the company reported its first ever quarter with over $1 billion in revenue. Shares now off over 5%. Yahoo Finance executive editor Brian Sozzi spoke to SoFi CEO Anthony Noto about the latest quarter of crypto and more.
It's really a continuation of what's been going right for the last 8 years. We have a sound strategy. We want to help our members get their money right so they can achieve their financial goals and the ambitions they have. We like to call that the American dream, have the house they want, size family they want, career they want, live where they want, retire when they want. So, we have to deliver a one-stop shop across buying, spending, savings, investing, and protecting. Those products have been built out since 2019, and since then it's been a matter of building awareness, building trust and reliability, and just making sure we're executing against that, in addition to offering new products and services and innovating. And so we like to say our durable growth is driven by consistent innovation and brand building, and that's resulting in strong returns that you see today.
Anthony, the bank earnings reports didn't exactly blow me away, but your quarter blew me away. What do you think this quarter says about the U.S. economy?
I think it says that the U.S. economy is doing okay. Part of our growth is from stealing market share that already exists, and some of it is organic from the members that we've already had for a couple of years. And so 37% revenue growth for over $1 billion is a pretty sizable quarter in terms of revenue to still be growing that fast. And there's no way we could grow that fast if there wasn't strong demand from consumers on spending, strong demand from consumers on borrowing and making sure they can still pay on time, which they're doing, and driving good returns for us there. But in addition to that, also still investing and investing in their future through our products. We offer not just single stocks, but robo accounts, ETFs. We did a number of IPOs in the quarter and a couple of private offerings for private companies.
This is a vastly different business, Anthony, from when you and I first talked. I think it was like 8 years ago when you were just getting settled in there at SoFi. You got investing products, crypto, you got the origination business. How should investors view a company like SoFi at this point in its life?
Yeah, I think the best way to think about us is we're going to drive durable compounding growth for years to come. Very much like Amazon was a one-stop shop for shopping online. They were able to gain more and more market share of the retail spending as it moved online, and that was able to drive 20+% growth for them for years. We're focused on 30+% growth. We just guided our first quarter of 2026 to 35% year-over-year growth, and the full year to 30% revenue growth. And then beyond that, through 2028, we believe we can maintain that revenue growth compounded annual growth rate and drive upwards of 40+% earnings growth. So the best way to think about it is we're capturing market share across all of the financial services products as they move from physical or old analog opportunities to digital, and we're doing it with a better economic model with 30% EBITDA margins, and we're leveraging technology to go into new areas that didn't exist before, such as crypto and blockchain and AI.
You teased a couple new businesses on the earnings call. Two of them stood out to me. One, secured crypto lending. What is that, Anthony? And then what type of risk does that present to your balance sheet as that rolls out?
Sure. So one of the products we rolled out was buy, sell, and hold cryptocurrency, which we used to offer 2 years ago, but we had to exit it based on being a national bank. Well, in the spring of 2025, the OCC put out 2 interpretive letters that basically made crypto investing permissible at a bank. So we're the first national bank that's offering buy, sell, and hold for a variety of different crypto coins. And as someone builds up a portfolio of those coins, we will lend them money against those assets. And not 100% of their assets, but a portion of those assets they can borrow and use that cash to do other things outside of investing for wherever they want. I would think of it as secured lending against your home. People buy a home, they put down 20% over time. That 80% that was financed via debt comes down as the equity value goes up, and as they pay down the mortgage, they can then take out a home equity line of credit, and the house is the security for that line of credit. So it's similar to that, except the cryptocurrency is the security for the loan that we're giving that person.
How important is it that the Clarity Act gets passed this year? And there's been a lot of different debates on what has held it back. Of course, you saw Coinbase CEO Brian Armstrong say the bill as it's written now is bad. What say you?
The most important element of the Clarity Act is establishing a law that it's permissible for banks to operate in cryptocurrency and blockchain. Right now, we're operating under the interpretive letters of the OCC, which is not law, which means if a different OCC chairman gets named that has a different point of view on whether or not cryptocurrency is permissible by banks, we could lose the ability to offer it. But the Clarity Act can establish it as a law that it's permissible for banks to operate in cryptocurrency. And the only way for that to be changed would be another act of Congress down the road. So there are a lot of elements of the Clarity Act that are very important, but that to me is the most significant element for anyone that's a bank or a national trust.
So you're making a big push into crypto. You got Coinbase out there, Robinhood, Kraken's out there doing crypto as well. How big is the market opportunity that big for all of these players?
It is, and we see it really pervasive across all of our businesses. We already talked about lending and investing. We just launched in December what's called SoFi USD. It's a stable coin. It is going to power SoFi Pay. So today we allow people to send dollars from the United States to over 30 international countries using Bitcoin. We convert their fiat to Bitcoin. We send it over the Lightning Network. It's converted to fiat in the local end into the bank. SoFi USD will replace Bitcoin in that transaction. SoFi USD will also be used to settle with all of our trading partners. In addition to that, we're going to offer big business banking. And the reason we're offering that is to give banks the ability to operate both in crypto and in fiat. And SoFi USD will be the means of corresponding banking between banks, but also be the way to move money cheaper, faster, and safer.
How big are you on this Kevin Warsh pick for Fed chair?
Kevin is a great pick as the Treasury Secretary, and we're excited that that decision has been made. Provides clarity, and the leadership has been consistent. Chairman Powell's done a phenomenal job over the time span that he's been there, but all great things typically come to an end. At 8 to 10 years is typically a time for a change, and the president obviously has the authority to do so, and he's acting on it. And I think all the choices that have been talked about, all 4 choices were all great options. Kevin is probably the one that's the most experienced, having been a Fed governor before. In addition to being a public markets participant, I think he brings a great combination of skills and experience to the table. So we're excited about it.
What do you think Powell's legacy is, Anthony? I mean, your business flourished under him.
Here's the reality. To be able to sustain an economic, stable environment through COVID, through 500 basis points of rate increases, people can poke holes on the margin about, inflation and having to act sooner, et cetera. someone much smarter and elegant than I am suggested that the Fed's job is to keep us out of trouble. And it would have been much better if we didn't have inflation, but we're able to actually get back to somewhat of a stable economy despite that misstep on inflation. And at the end of the day, it's not always the path of how you get there. It's what the outcome is. And, if you look over that span of time in aggregate, it's been a pretty good time for the United States.
Speaking of the 8-year mark, March 1st, officially, I think, your 8 years SoFi CEO. I don't know where time has gone. I mean, this isn't your goodbye interview with me, is it? I mean, what's going on here?
No, not at all. Okay. I'll be at SoFi as long as they let me, or someone takes me out in a horizontal position. So this is my baby. It was nothing like it is today when I got here. There's about 650,000 members and 250 million of revenue in 2018, and we just finished 2025 with 13.7 million members, 20 million products, and over $3.5 billion of revenue. So as much as it's been a great run, I feel like we're just getting started, and I couldn't be more excited about the future.
I know you're a big football guy. You all in on the Patriots? Where are you at for the Super Bowl?
We are, we're from the Northeast. We moved to California 11 years ago, and we lived in Connecticut, so we're Patriots fans.
Okay. All right. I'll take that as a pick. Anthony Noto, good to see you. It's been a while. Don't be a stranger. We'll see you soon.
Great. Thank you, Brian.
Coming up, Alphabet and Amazon are set to report next week, and analysts share his expectations. That's next on Market Domination. Elon Musk is reportedly looking at ways to consolidate his massive empire. According to Bloomberg, he's considering merging SpaceX with Tesla or with xAI. This comes as SpaceX is expected to IPO this year. And joining me now to discuss what a tie-up would mean for each of these companies, we have Yahoo Finance tech editor Dan Howley and Yahoo Finance senior autos reporter Praz Subramanian. Praz, start with you, my friend.
Yeah, look, there's a lot of ways to go here with this. SpaceX is a rocket company. What could they possibly need or do with Tesla? And I think that on the face of it, you might not see that many sort of options there. But I think if you dig down just a little bit, we know that, for instance, SpaceX, in addition to obviously launching rockets and also their satellite Starlink service, they also potentially want to do the data centers in space, right? So that's where you might have a company like Tesla with this manufacturing prowess there, helping you build those things. Tesla also builds solar cells through its Solar City division. Solar cells are going to be installed on the data centers to sort of power those things. And then Tesla also has its own chips, its own AI chips. And you might see those chips make their way into these data centers. So there's a lot going on there from a tertiary manufacturing technology point of view. You're not going to see cars flying into space, but you might see some data centers up there.
All right. So, Dan, now we got the Tesla take. Walk us through, Dan, what it could mean for xAI.
Yeah, I think this really has to do with a lot of the AI aspect of xAI and the potential tie up there with SpaceX. Obviously, the compute that they have at SpaceX, it would benefit them, obviously, as Prod said, when it comes to those data centers in space. The big thinking there is that, they spend a lot of money cooling these things. They take up a lot of real estate. And so maybe you can make them more compact if you don't necessarily need to cool them on Earth. And so we'll just chuck them up into space and see what happens, I guess. The viability of this is being looked at, obviously, by SpaceX and others as well. I think one of the issues that, could crop up is a little thing called maintenance. Not too sure if they would just start, putting astronauts into orbit on the reg to, replace a server or something like that. So, it is kind of a strange sounding tie-up. But if they can do that, obviously that would benefit xAI immensely, either training or inferencing. It's not as though xAI doesn't have their own data centers here on Earth. They do, and they're building them out. They have the Colossus that they have. But as time goes by, they are going to need more computing power. I also think that as technology advances, you may not need as many data centers or as much horsepower for some of these models as you do now. And so the long-term reality of this is they just may not have to launch anything into space at all. And this could just be a way of, making sure that everything is under one roof and easier to track.
Praz, jump back in here. You have a question for Dan?
Let's just get crazy with it, right? I mean, look, Tesla makes Optimus robots, right? Why can't we have these robots up in space, repairing and upgrading these data centers with jetpacks? I mean, Musk said supposedly Tesla's working on an air powered, thruster, right? That's what they use in space, right? So, I mean, I'm just having a little fun here, but I think that's what. I mean, Howley, we're talking about Howley's being more realistic about what's happening. I mean, the fact that you would think of a thing flying in space, beaming back data back to us that's been then used to power a car driving around the street, it just sounds insane, right? But that's sort of where Musk's mind is. He's kind of looking to the future, 5, 10, 20 years ahead. And I think the issue, not the issue, but the interesting part is, it seems like investors and the investor community is buying the argument. Look at Tesla stock right today. They like what they see with that union, and maybe there's permutations that we don't even know about.
Yeah.
Yeah, I mean, and I think the thing is that they look a lot at these promises. Obviously, whether that's the self-driving or the Optimus, and they say, well, this is going to happen, and it's going to be huge for Tesla. But I think the hard reality is, there was going to be tons of self-driving cars some time ago. The robots are supposed to be, marching around shortly. These timelines are all real fungible, but it would make sense to use robots in space for, either in the sense of exploration or things along those lines. But at a certain point, I think that loses kind of the humanity of space travel and what I think gets people truly interested in it. And, you're an astronaut, you probably want to go to space, not have a robot do it, right? Like, if it's me, all things considered, I'd rather go to space. I'm not at all. I don't even, bungee jumping is too crazy for me. Strap myself to a rocket, no thanks. But if you want to do that, I'm sure you'd rather that than a robot.
Yeah, to your point, Prize, it was so interesting this week when I spoke to a Tesla shareholder, a Tesla investor to go over those results, and try as I might, man, I could not even get him interested to talk EVs. It was robots, but we'll leave it there. Guys, thank you both. Appreciate it.
Thanks.
Microsoft, Meta, and Apple put forth a mixed bag of results for investors, but Wall Street sending a strong message to tech giants. The pressure is on to prove spending can power growth. Next up in the hot seat, we got Google, we got Amazon. Joining me now to discuss all of it, Citi senior analyst Ron Josie. Ron, it is good to see you. So you cover Amazon and Alphabet, Ron. You also cover Meta. They reported investors like what they had to say. Are there read-throughs in that Meta report, Ron, to Alphabet?
Yes and no. From an advertising perspective and a consumer and engagement perspective, I think the answer is absolutely yes. So advertising was a big surprise. Overall revenue growth was a big surprise for Meta. Maybe not for 4Q. I think people were looking for that 24% growth. But the acceleration that the company reported for 1Q or expected to report for 1Q in their guidance up to 33+% growth, I think that was a big surprise. And underlying that, yes, Meta's doing some pretty fantastic things with their AI ranking recommendation models that is specific to Amazon. But underlying that is a broader overall what we call healthy online advertising market. And I think Meta or Google, Amazon, others participate in that as well. So there are some read-throughs there, and we're incrementally positive on Google and Amazon and Reddit post-Meta numbers.
Just sticking with Google, Ron, interesting to get your thoughts on all things Gemini. Just what the adoption curve and trends look like there, Ron, and also just how you kind of think about long-term the relationship and impact with search.
I mean, Gemini is something that's impacting the entire organization, and that's what's making Google so attractive, or at least so interesting from our perspective. Google is amongst our top picks there, and Gemini is powering Google search, and we're seeing overall query growth accelerate. At least we did in 2Q and 3Q. We expect that to continue. In addition to that, we would say that both AI Overview, AI Mode, and Gemini all merged together into one, that it's just going to be one Google search here over time. Maybe that happens this year. All of that is being powered, and the innovation around search is because of Gemini. And then you have to look at Google Cloud, right? Google Cloud, of course, Google has the silicon with TPUs, but Gemini is basically what's opening the door for the Google Cloud business to basically accelerate their revenue growth. And so Gemini is impacting the entire organization. Consumers are adopting it. enterprises are adopting it, and then you're seeing it being infused in so many of Google's products, whether it be Gmail or Maps, and the list goes on and on. So it all sort of starts and ends with where Gemini is going.
You know, you look at Alphabet, just a chart, Ron, heading into this print, the stock it's a monster. It's up about 70% over the last 12 months. I know you have a buy on the name. Are you a pound the table buy, though, Ron, at these levels?
Yeah, we are. There's some concern around the multiple, and that historically, Google sort of hits the top of the multiple at these levels, call it mid 20 time ranges on GAAP EPS. But our view here is that search continues to be very strong. And the minute we see potentially search, at least stable, if not accelerate revenue growth, a la what Meta did, I think that could be powerful. You have Google Cloud. We just talked about the demand because of not just the silicon, but also on the software side and all powered by Gemini. So we think there's a lot of tailwinds that are happening in Google's core business that can continue. And if that's the case, then I think the stock can re-rate even higher.
Let's talk about Amazon as well, Ron. Those earnings on deck. I know you have a buy on that name as well. I recently had Mark Mahaney on the show, Doug Clinton. I mean, those are two very smart veteran analysts like yourself, Ron. They both like Amazon independently, they told me, in 2026. You do as well. Walk me through why.
Yeah. So, I mean, to be clear, Amazon is our top pick for this year, followed by Google. So the 1 and 2 in that order to your prior question. What are the tailwinds for Amazon? What makes us so excited? Well, it starts and ends on AWS. We actually think that 2025 was the year that Amazon was able to add incremental capacity such that they can satisfy their demand for AWS overall. And we're seeing that. And so if AWS continues that reacceleration, their growth rate, I think that answers a lot of questions. And then you have the core North America retail business doing very well. I don't think they're losing share. I think they're maintaining share, even as Walmart does better and better. There's concerns about agentic commerce. I think Amazon's going to have a good strategy there over time. But the bottom line is you get into perishables with grocery, and essentials becomes a bigger part of that business, which is already at $150 billion. I think the share of wallet grows. The amount of times you get your packages, it's almost unfathomable to think we get them more often, but I think that happens. And guess what? The organization becomes more efficient. And so from our perspective, Amazon has AWS reaccelerating. We've got the retail business doing better and going into newer areas like grocery and essentials that are driving higher conversion rates. And then we have better overall profitability from a GAAP OI perspective. And you're seeing it from the organization being more efficient. You're seeing that from the fulfillment centers being more efficient as well. And you put all that together, this is a stock that hasn't necessarily worked as well as Google or Meta the past few years. It seems to me that they have all the pieces that can turn the tide there.
Ron, final question, just if I can sneak it on Amazon. On AI, Ron, there is this sort of perception that Amazon is kind of playing catch up, chasing rivals like Google. I'm just curious whether you think that's fair.
Look, Amazon does not have a Gemini model. Amazon does not have a chip at the same level as NVIDIA's GPUs or Google's TPUs. However, they do have models called the Nova model, which are for cost-effective type clients. So and they've got Bedrock, which is their model garden. So from an AI offering perspective, I think they actually have all the tools that are needed, and their Nova strategy is just that, to help clients do their training as they get into more inference. Then you've got their own chips, their Trainiums. They're on Trainium 3 this year, soon to be Trainium 4. You have some very large AI native like Anthropic companies that were built, my understanding, on Trainium. So I understand the thesis or the fear that maybe they're not where they are. And you look at Google and they've got the TPUs, which are very effective. You have Gemini as well. But I think AWS's pieces of the puzzle are absolutely coming together for AI, for sure.
Ron, so good as always to have you on the show. Thank you.
Enjoyed it. Thanks.
Coming up, we check in on how options traders are navigating the big moves in metals and big tech as part of our options playbook. Don't go anywhere. been a busy week in the markets with mega cap tech earnings and a wild week for the metals trade. We're digging deeper into the action in this week's options playbook, sponsored by Tasty Trade. Joining me now, we got Neil McDonald, CEO of Moomoo. Neil, it is always great to see you. So let's start here with big tech, because we've heard from some big names. You got other big names on deck. We got Amazon, we got Alphabet. Where are you seeing the most options activity in tech right now? And are you seeing it, are they expressing bullish views, or are they hedging downside risk? Walk me through it.
Yeah, so certainly for what we see, the most popular stocks amongst Moomoo clients are the kind of the Mag 7, the big tech stocks. So last week, I think Meta, the implied move from the options just before the earnings was about 6%. Obviously, it had this huge high to low move. Since then, we've seen overwriting sellers. A lot of our clients don't trade single options just on their own. It's generally alongside their portfolio. They use it for income, for yield enhancement, for protection. Tesla, one of our biggest traded options. It's always interesting, Josh. There's the people taking positions before results, and then they digest the results, they think about it, and then the really big block trades and activity happens post earnings is what we see. So huge big overwriting calls today on Tesla. For next week, Amazon, we're seeing slightly bearish on our indicators today. We have a platform that looks at unusual options activity where the blocks are. So overwriters in Amazon, the 247.5 to 250, some decent size there today. A slightly upside in like the 350s in Google. So slightly more bullish for the outlook for Google for next week.
Let's talk metals too. Gold and silver. Blistering runs today, getting
what
whacked.
What a day.
Okay. So I'm curious to get your take on that. How investors are using options in metals, and whether it's different than equities.
Yeah, if you take SLV, for example, last year it wasn't in the top 50 open interest or volume. I look back to December 16th, it was number 8 in our list of highly traded and higher open interest. It's now, as of yesterday, it was number 3, just behind Nvidia and SPY, which is bonkers. So. There's a lot of short gamma out there, a lot of demand, and as you see, the market couldn't digest that demand. The move today, lots of market makers short gamma, absolutely exacerbated the move to the downside. To have a 30% move in any instrument in one day, especially something that's heavily traded as SLV, was surprising to us. Even GLD has gone from number 25 to number 15 to number 8 in our open interest and volume charts.
Bigger picture question. What's sort of next for the options market that's on your radar that you think, okay, this could push this market even sort of deeper into the mainstream?
So big news this week. We have this 28 million person community. We did a live cast with NASDAQ for the dailies they're bringing out on the Mag 7, Broadcom, and IBIT. I spoke to them this morning. They're seeing decent volume. It gives investors. It's more precise. If you just got it was monthlies, then weeklies, and now dailies. So if you had a weekend news or something happening on a Monday, if you're just trading the short dated Friday options, that's still a lot of decay to eat up if you're a buyer. Having Mondays and Wednesdays gives our clients, and I think all option traders, more precision, more chance to be surgical about where they pick their spots, where they overwrite, where they buy their puts.
Neil, always great to see you, especially on set. Thank you.
And you. Thanks, Josh.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.